Welcome to the Real Estate Investing Club. This is the place everyday real estate investors gather to share their best stories, biggest insights, and favorite tactics to grow a portfolio of cash flowing properties in today's market. Here's your host, Gabe Peterson.
All right. Happy Friday, everybody, and welcome back to another episode of the Real Estate Investing Club. If you can hear my little beagle outside, she is furious at the neighbor's dog, so I apologize about that. But it's going to be a good episode because we got Zach Lemaster with us on the podcast. Zach is from Rent to Retirement. They build turnkey investments for investors out there. But Zach also has a lot of other experience, built to rent, luxury, short-term rentals, commercial, retail, multifamily, you name it. Zach's been in it. A lot of experience to go into here. So I am super excited to jump into it. Zach, thanks for hopping on the show.
Gabe, I'm excited to be here. Thanks so much for having me.
Absolutely. I told you before we got on here, we always like to start with stories and hear how you, the guest, got into real estate and what your story has been up to this point. So why don't you take us to the beginning of your experience and tell us how'd you get in?
Yeah, absolutely. I'll try to keep this somewhat concise, but I've been investing for just about 15 years now. For many of us that find ourselves full-time into real estate, I didn't start there. So my wife and I have a background in healthcare. We're both optometrists by education. I was on a scholarship with the Air Force, so I joined the Air Force, commissioned as a captain. Started practicing optometry. I was stationed in Grand Forks, North Dakota, and then in Germany as well. But I mean, that's where I started investing in real estate. I think I read, Rich Dad, Poor Dad, like most of us do at some point in time. But I just like the idea of real estate. Bought my first house as duplex, house hacked it, lived in half, rented out the other half. I used a VA loan, being in the Air Force, so I was able to put zero money down on that, which is a great loan, and fell in love with real estate as a tangible asset. Right, I love the idea of, hey, I can own a property, really putting essentially no money down where I can live for free, but I also own an asset that I get tax benefits from that grows in value over time. And so the next year, we bought another duplex and continued to buy time and time again. But there's a pivotal moment, Gabe, that really changed the trajectory of my wife and I, our lives in general, our business and our investing career path. And that's where we started to learn how to invest out of state, outside of our local market. North Dakota was an okay cash flow market, not a real great appreciation market.
North Dakota, wow.
Yep. So, like some of the Air Force bases, they're stationed in pretty desolate locations. But, so we learned how to invest out of state strategically. And that was a rough start to begin with. But really, once we figured out the process and system, how to identify the best markets and opportunities throughout the country based on our goals, that allowed us to dramatically expedite and expand our success in real estate investing to the point where we were able to replace our active income, both as doctors. I left the Air Force. We moved out to Colorado, which is where I'm at today. We were in private practice and essentially slowly over time retired ourselves out of the healthcare profession through real estate investing. And so this was kind of the birthplace of our turnkey company, Rent to Retirement. We had a lot of friends and family and colleagues that were saying, hey, we see this success you're having in real estate. We want, can you help us? We're busy with our jobs and our families. We don't necessarily want to be a full-time investor. We don't know how our local market may be too expensive to start with. Can you just help us invest? And so we really started Rent to Retirement, almost 10 years ago, following that process, the same process that we did of identifying the best markets and then, building, either finding and rehabbing or building inventory, leasing and managing those, because we already had our teams established in those areas and we just scaled what we were already doing for ourselves for other investors. And so fast forward to where we're at today, our company works across 15 different markets, mainly in the Midwest, Southeast. We mainly focus on build to rent properties. We're building new construction houses in A-class locations, as single family and small multi, where we lease and manage them for our investors. So they have access to easily acquire properties and build and scale their portfolio without having to, buy themselves another job being a property manager, and regardless of their, location or experience. So that's the quick on my story, I guess.
Yeah, it's hard to distill 15 years of experience into a 2-minute story, but you did a good job. It sounds like you really started out with that duplex house hack. I like that. That's actually exactly. Well, I did a few flips before I bought my first rental, but that was the first long-term rental that I got, was a house hack. Lived in one side, rented out the other, and I ended up flipping that one and buying a mobile home park. So I love that strategy, and I think it's great when other people do the same thing. So you mentioned a lot of things in that story. Out of state is one of them. I always recommend people do out of state, but then I get to thinking, and I'm like, well, not everybody can do out of or would even want to do out of state. It's really for people who are in areas, coastal cities, especially where the cash flow just really doesn't make sense. I'm in Seattle. It's really hard to find decent deals in Seattle. And it's not like you can't, but it's just they're much better cash flow areas, much better cash flow cities that are out of state. And so once you can unlock the ability to invest outside of where you live, that really does open your world. So you guys have gone in a lot of markets. I think you said 15 different markets that you're invested in. So you've created a process around opening new markets, around identifying areas and then setting up shop in that area to be successful. Let's break that down on the show right now, starting with identifying the market and choosing where you're investing. Colorado, what'd you say, Denver, Colorado?
Yeah, that's where I live. Now
That's
we
where you
don't
live,
do
yeah.
we don't do active deals here. I personally invest here, but Denver, like Seattle, is one of those markets
Yeah.
that just kind of doesn't make sense. But yes.
Yeah, that's what I was going to say. So take the mindset of somebody in Colorado. They're just getting started to invest, but they can't invest in Denver because prices are, what is it, 500, 600,000 on average in Denver. So walk us through identifying a new market and then setting up shop there.
Yeah, happy to. And I do want to touch on your first point just about mindset, because I think investing out of state for the first time seems daunting. And there's nothing wrong with starting locally, but as you pointed out, Gabe, there could be a higher barrier of entry, right? Not only could the property not cash flow if you put 20 to 25% down in an expensive market because rents don't justify that, but it also requires a significant amount of money, right? Just to get into that first deal. Or maybe there's legislative or tax things that you need to be conscious about. If you have to evict a tenant, there's a lot of states in the country where, hey man, it could take a year or longer to evict a tenant, right? Those are challenges you need to be aware of. And this all comes into play when we identify a market. So we strategically try to find the markets throughout the country where we can find the best cash flow and appreciation, the best investment opportunity, where there's supply and demand, discrepancies, but also just where are we going to build a portfolio that's going to be sustainable long term and allow us to actually operate it like a strong managerial portfolio that we want to see. So all those things come into play. But essentially, when we try to find a market, we have fundamentals that we want to reach. We want to be an area, and I touched on a lot of this, but we want to be in areas that have landlord friendly legislation, low taxes. We want to be in areas that have an undersupply of housing. There's a deficit of 7.2 million houses in the U.S. right now, which is the worst it's ever been. We have a lot of people coming into this country where there's a population shift throughout the country, mainly down to the Sun Belt, to the Southeast. There's a lot of people moving there. We want to be in areas that are affordable. The average home price in the U.S. is, right around that $400,000 price point. We want to be well below that. We try to build houses in that $200,000 to $300,000 price point. That gives us the largest tenant pool, but also the largest resale pool of buyers when it comes time to sell the house and maybe 1031 exchange. We would want to be in areas that have a diversity of industries, not just an area that's relying on oil and gas. So it's all about being in the path of progress. But that's on the macroeconomic scale, right? These are like state legislation type of things we look at. Once we enter those areas, then we look on a microeconomic scale to determine, all right, what are areas where there's an undersupply and areas that have a huge need? And the majority of what we do is ground up construction. So we build houses, obviously, like all builders do, in areas where there's housing need. And so not to oversimplify it, but also to point out that, this isn't rocket science. If you're in a place where there's housing demand and the rent numbers make sense, and the costs make sense, then, you probably will do pretty well in those locations. But, we have people attending city planning meetings who want to be in areas. We look at where jobs and transportation is being developed, where there's an undersupply of housing, where the cost makes sense, where the rent to price ratio makes sense. And then we just build our teams in those areas, and that's served us well for many years.
All right, that's a lot to take in. So it sounds like, the I want to say soft because they're not like there's no numbers that you can put to it, but I guess the soft criteria are all around legislation and how landlord friendly it is, and then the hard criteria are industry growth, economic growth, population growth, all that kind of stuff.
Numbers specifically, though, just to point on that. So below the median house price point of 400,000, right? We want rents to be about that 0.7, 0.8% rent to price ratio. That allows us to know that if we have, say a $300,000 house that's running out at $2,600 a month, that's going to produce with conventional financing 20% down a 8% or better cash on cash return. That's kind of our baseline,
Oh, interesting.
that we try to meet.
So if you, I don't do single family, so I'm not familiar with that. But you're saying that if you do 80% of or 8% of the gross or of the price of the house, if you can get that in rent, then it should cash flow or give you a cash on cash return for
Yeah,
no, it's
well,
the same thing. Sorry,
yeah.
cash flow or cap rate for at 8%.
Yeah, so usually, that point 0.7, some of those metrics, and these aren't hard and fast rules because there's a lot of variables. For example, taxes come into play with that, right? That's why these rules of thumb, like rent to price ratio, really are somewhat irrelevant,
Right.
because you have to look at all the expenses and then also all the debt, aspects of it. But when we usually evaluate a property, most of our investors are buying with our conventional Fannie Mae, Freddie Mac loans, where they're putting 20 to 25% down, because that's what that requires. We want to make sure that they are achieving at least an 8 to 10% cash on cash return based on the rents in those locations. Sometimes we get much higher than that, but those are usually the fundamentals, as well as being in a growth market where they're going to have appreciation. And then we have some unique financing options where people can come in and actually acquire a property with anywhere like 0% down or 5% down on true investor loans. These are not like you and I did. We're not talking about living in the house. These are true investor loans that are unique, available for residential. We have options where rates can be down as low as 3.99%. So that's like the creative aspect where we match the property with the right financing option, to meet the investor's goals to allow them to ultimately scale their portfolio.
Got it. So let's hear your. I mean, sounds like you've already done all this research for the ones that you're in. So what are your top 3 favorite markets you guys are in right now?
Most of those will be in the Southeast. That's where the population is growing. And I'll say caveat with this. I'll talk about the markets that I'm most excited about, but often what we found too is this is a very individual, process for investors to follow. Just because I state these markets, it may make sense for an investor to invest in the Midwest, where they can buy a house for $120,000. That was maybe going to cash flow better, but not be a super appreciation market, right? So it's all about matching the right market and properties to the investor. But the markets that I think that are positioned for the best opportunistic growth, that cash flow well now, I like Huntsville, Alabama. This is an area that we do a lot of construction in. The average home price we're building there is about $320,000. Huntsville has just grown all the time. I mean, the NASA, government, tech, there's just a lot of growth opportunity in Huntsville. We like Southwest Florida. So this would be like Fort Myers, Cape Coral, Tampa. These are areas that the population is growing tremendously. And then I think the third market we really like is probably San Antonio, Texas. Texas is a little bit, it's a little bit challenging because property taxes are about 2% for investment properties. And so again, that just comes into the numbers play, but we're actually doing some unique things in San Antonio with midterm rentals and short-term rentals where, we can make those cash flow significantly better than you could at a long-term rental. And there's extreme demand for those with, military, government, housing, as well as some other things like universities. So those are the markets that we really are bullish on.
Nice. San Antonio is such a big market. It's like a massive city. I flew down there for to look at a self-storage facility, and when I was flying over the city, I was like, this thing never ends. It's bigger than LA.
It's bleeding into these secondary markets too, that's kind of expanding. And, that's a point that's interesting to explore. For example, Orlando is a market that is too expensive. And there's also legislation, things like that, but it's just unattainable to really break into Orlando. But you can be 20 minutes outside of Orlando in an area that we build called Poinciana or Polk County, where, the house is a fraction of the cost, but the rents are actually relatively comparable to what they are in Orlando. And families are moving out to these, secondary markets or suburbs where, it's more affordable and they can still commute to, some of these large metropolitan areas. So that's another unique thing that we've been able to be successful with.
Yeah, tertiary markets. Okay, so once you identify your markets, what is the process that you guys, and let's say pick a market that you've never been in. Let's just say Indianapolis. I don't know if you're in there now, but just choosing a market on random. What is the process that you guys would follow if you had identified Indy as a city you want to be in and you want to set up shop there? What are the first 5 steps somebody who wants to kind of replicate what you're doing would have to do in order to be successful in that market?
Well, the first thing, let's assume we've done all the market data already, like all the points that we talked about, and we've decided that, hey, Indy, and we have worked in Indy, but let's say this meets our criteria, right? This is a growing market. The cash flow numbers make sense. There's a demand. People are moving to the area. Jobs being created. There's affordability. So first thing we do is we identify the submarket that we want to be in, and we usually choose a geographic location within 5 square miles or something like this. This is an area that we're going to be doing construction in. And then we have to build our contracting team, right? So we always go through local brokers to identify land and sometimes land wholesalers. Now we're doing a lot of ground up construction. Sometimes we acquire properties and renovate them and lease and manage them for investors as well. So they're not new build, and those are kind of two different processes. But first and foremost, it's all about connecting the team. So if you're an investor and you just want to break into a new market, and you decided that, hey, your local market's too expensive, or you want us to start diversifying, first thing to do is evaluate the market, right? And this is kind of overwhelming sometimes because there's so many markets, right? It's like, how do you even choose what is the right market? And we do have tools and resources for people to use. They can use and leverage our market data. If they want to go out and do it on their own, they can, visit with our team and obtain that information. But the first thing that we do is, go through and make sure the numbers make sense. And then it's just connecting with all the right people. And this is where the most of the obstacles happen. Because if you're going to be investing out of state, you need your team, right? And you have to, if you can't tap into an immediate team, I mean, that's kind of what we offer someone to easily tap into an established team. But if you're trying to build your team from the ground up, you need to have the right broker there. You need to make sure that they're knowledgeable about the market and investing in general. There's a ton of agents and brokers, but very few of them that are savvy investors and successful investors themselves. You need to make sure you have the right property management team. Sometimes this is just trial and error. Now, how you get those recommendations, I think you start attending, whether it's virtually or in person, some of the local RIA groups, some of those are online, and start asking for recommendations and references, right? Contractors, agents, brokers, insurance providers and lenders that can service that area. Property managers is a huge one. And so getting those referrals, but for us, a lot of it is trial and error. So we'll do all of that. And we have our own internal criteria and checklist that we use to, that every person that we work with needs to meet. But at the end of the day, you just have to hire them and work with them and start slow, right? You don't get over the tip of your skis, but start slow with them, make sure that the experience is good, and be quick to fire them. If they're not the right people, fire them and move on. Sometimes you have to go through 10 or 20 bad contractors or property managers to find a good one. And then once you do find a good one, you hold on to them, you pay them appropriately. I mean, what we've been able to do with our experiences is add best practices to some of these teams, right? We know exactly what we're looking for. And if there's a team, a managerial team that doesn't have every single component, but we know that they're doing good at what they're doing now, we can also share best practices with them on things like tenant vetting, right? And to improve their leasing process, to improve occupancy, reduce vacancy, maintenance procedures, all these things. And so, at the end of the day, if you're going to do it by yourself, there's a lot of time and energy and risk involved in that. But you have to, it's all about connecting with the right people.
Yeah. Yeah. Building the team, in my opinion, is probably the hardest thing. Not hard as in, it's not, it's, as you said, it's not rocket science. It just takes a lot of trial and error. I wish there was an easy way to do it, but there's not. We actually almost sold 2 of our mobile home parks because we had a really bad property manager. And that's how big of a difference a property manager or a member of your team can make. It makes an individual property almost untenable to manage. And once we switched over to a good one, we had went through a couple property managers. We finally found the one we're working with now, that is just a rock star. It just was night and day. And so building that team is super hard. But once you do find the good ones, you got to hold on for sure.
Yeah, sometimes it's a school of hard knocks, right? Like you get some bumps and bruises, and sometimes you lose money dealing with the wrong people, right? But you learn, and then it helps you with the process of finding better people. And not to pitch our company too much, Gabe, but on the easy aspect, like that is what we try to do for people, right? Is have easy access to deals and teams that are already established, where someone can easily tap into that and buy the property, and have our teams that we've already vetted and put in place to manage it for them. So that's the value that we try to provide.
Yeah. Yeah. As a business model, the build to rent model makes a lot of sense for people who do not want to be an active investor. They don't want to make their, investing their full-time thing where they're going out, they're looking for deals, they're building teams, that kind of stuff. So they just fit in with somebody like you that is doing that for them. And they can take the benefit of the cash flow, the tax deductions, all that stuff, while having their other job or enjoying their life in some other way. So I get it. I think it's a great model, and it's good you guys are doing well. I'm going to take that opportunity to move us to the quick question round because it looks like we have gone through our time. Are you ready to rock?
Let's do it.
Let's do it. Starts with education, could be any form, could be books, movies, YouTube shows, podcasts, whatever. Give me 2 recommendations, one for general life wisdom and then one for real estate. Before we continue on with today's guest, I want to tell you guys about a community I'm launching on School to help investors like yourself grow your own portfolio. In this community, you'll get access to all the docs I use, all the systems I've built, everything I've used to grow my own portfolio, as well as instructions and guidance on how to get out there and find great deals, how to finance those deals, and then how to manage them for great returns. Since we're just launching it, the price will be set at a measly $20 per month, and whatever price you join at is the price you'll have for life. We will be increasing the price as the group grows, so if you're at all interested in growing your portfolio along other investors, now is the time to join. I will put the link somewhere in the bio or on our podcast website at therealestateinvestingclub.com, so if you are interested, head on over there. With that said, let's get back to the podcast.
I'm going to say general would be, I'm going to overlap this with business, assuming that you're operating your own business or real estate business, because real estate is investing is a business. But I really like the E-Myth, the entrepreneurial myth by Michael Gerber. I mean, that's just really focusing on building your business, not operating in your business, right? So an example would be not be your own property manager, learn how to operate and hire the right property manager, like we exhausted earlier. As far as with the second one, real estate specific, is that what you?
Yeah, general life wisdom and then real estate.
Real estate, I'm just throw out some books here and then a caveat. So obviously most people probably read the Kiyosaki series, which is great. Additional beyond that, I would say The Millionaire Real Estate Investor by Michael Gerber. I'm sorry, not Michael Gerber, Gary Keller, founder of Keller Williams. That's probably the best book about how to think about how to scale and really grow a large portfolio. But I'll say this too. I'm always been a big advocate for firsthand experience. Like you can listen to as many podcasts and read as many books as you want to, but at the end of the day, get started, right? This doesn't mean you have to make all the mistakes everyone has made before you, but like own property and get in the game, because that's where true education comes from.
Yeah. I've said that 1,000 times on this podcast. Definitely get a baseline of education, but once you get that, just do something. Just go out there, buy land, buy a single family, buy whatever, because what you learn from actually doing the process it just can't be taught. Obviously you can say the things in a book, but it doesn't really click until you actually get it done. So
100%.
Good advice. All right. Next question is for your younger self. So let's go back to the Zach who was, I think you mentioned Germany. Go back to the Zach who was way back in Germany as an optometrist on an Air Force base out there. Go to him, look him in the eye, give him one piece of advice moving forward.
So much I could say to my younger self. So everyone could say, I wish I got started earlier and been more aggressive, but I would say
that's actually what everybody says. So it's funny.
I'll give something different than here. I'll say something that has been a painful lesson for me to learn is to date before you marry in partnerships. Partnerships can be extremely powerful to help you scale your portfolio, especially if you're raising capital, you're bringing in, investment partners or whatever the case is. Some people are too quick to jump into partnerships because they like the idea of working with someone, but it's like you don't actually need a partner. We formed some partnerships early on that we just really jumped in heavy with. We had some success with, and then it crashed and burned, and people were not aligned in their goals. Yeah. And that's cost us 7 figures of mistakes in the past. So I would say be conscious about partnerships. Is a very valuable tool. Be realistic if you even need a partner to begin with. And when you start a partnership, start slow and make sure you are very clear and intentional in outlining, your goals and make sure they align.
Yeah. Partnerships can be difficult. I personally think that they are worth it if you can find a good one, because it just makes, I do feel like partnerships get more, have more results. They have greater success, but it's also just more fun to be in a partnership if you have the good one. That's the caveat. If you find a good partnership and you each understand what your roles are, that's a good partnership and you should definitely go for it. But yeah, it's definitely, you should be wary about going into them. That's for sure. All right. I've already asked this, but I'm going to ask it anyways because it's on the list. United States is a big place. There's a lot of opportunity. You've already mentioned your three big metros that you're excited about. So I'm going to ask you to whittle that down to your most favorite metro that you're looking forward to invest in today.
Then I'm going to have to stick to the first one I said, and this is the corridor between Huntsville and Birmingham. There's about 70 miles between this area where there's a lot of secondary and tertiary markets, a lot of jobs going to that area. Alabama, low taxes, landlord-friendly place. Average home price that we build there is like $220,000. That's renting out for like $1,800 a month, just killing it on cash flow. Lots of opportunity. A lot of people that aren't familiar with the area thinking, why would I invest in the boondocks in Alabama? But that's where a lot of population and jobs are going, and there's an extreme demand for housing. So not only can you get into a brand new build for like low money down, but there's really a lot of opportunity for growth there, and we've been extremely successful. We raise our rents 7% on average per year, which is more than double the national average. That's how much the demand is for rent there. We're just killing it.
Wow, that's interesting. Huntsville and Birmingham. All right, second to last question is about lessons learned. Not every deal that we get into goes the way that we expect it. In fact, sometimes we get into a deal and it goes a little bit south. But those are the times when we learn our biggest lessons. So what was a deal that went a little bit sideways for you? And then what was the lesson you pulled from it?
Yeah, lots to learn. We could talk all day on this, right? But what makes us successful investors is to have the tenacity to stick through the bad deals. I mean, sometimes you got to trim the fat and just sell the bad deals. But some people are so quick when the first issue pops up that they throw their hands in the air. So you got to have grit in this game, and you got to see your way through. Our first properties out of state that we bought were a nightmare, and we bought them from someone else that was pretty much a turnkey provider. So this was a bad experience, but this laid the foundation for us to build an immensely large portfolio and create generational wealth and financial independence from learning those lessons. So we bought some houses. These are duplexes. They're in Southside Chicago, where they call them two flats. And they were in a probably D-class neighborhood, beautifully renovated houses. With tile and backsplash and all the things, granite countertops. But management did a terrible job. We had tenants that just trashed these beautiful rehabs. We had Chicago Housing Authority, so Section 8, and they were a nightmare to deal with. And we had to go through multiple evictions. We just lost a ton of money on those. And we ended up selling each one of them. We bought 3 of them. But that was our first experience investing out of state, and so many lessons learned from that. But that was a catalyst to say, hey, we see the opportunity investing out of state because, as I said in the beginning, that's what allowed us to build our business and financial independence through real estate. But we had to reset. We had to take each one of those lessons learned and say, look, this is this is how we need to approach this. These are the team members. These are the locations we want to be. It's just simply investing in better areas. Like now we exclusively focus on B plus and A locations where it attracts better tenant quality. And the second piece of this I would say to Gabe is that so many people get tripped up on just looking at pro forma and just looking at the numbers, right? And thinking that this is how the property is going to perform forever. Everyone, a pro forma is an estimate of an evaluation for year one. And this could be good or bad. It's the seller giving you an estimate of the numbers. Like we do this as well, right? We put together a pro forma on our properties. We have justification and a track record to justify those numbers, but be conscious of who's showcasing the numbers and also learn how to run the numbers year 5 and 10, because rents go up every single year. Your mortgage should stay flat. Expenses increase. Appreciation comes into play. Some of those things are, less tangible and hard to calculate, but real estate is won over time. So when you have issues, have the grit to stick through those. Some of my best performing properties did start out as nightmares, and I fought my way through them. Anyways, I could go on and on, but hopefully that's enough.
No, that is 100% true. I couldn't agree more. I would say, like, when you're underwriting properties, especially on the commercial side, I don't know, do your own thing, but I would never buy a property that's not cash flowing, even if year 10 looked rosy. Because man, they're holding a property that's taking money out of your pocketbook is definitely difficult. But yeah, those are some good lessons. That leads us to the very last question. This is for the listeners. You've given us a lot to think about. I'm sure people want to reach out, get in contact with you. This is a 2-parter. Where can they find you? And then what can they expect when they reach out?
Absolutely. So the first thing they can do is go to our website. We have our YouTube channel, our podcast with a ton of information about all things real estate. especially like what we talked about today, which markets. We do a lot of market data. We share that with the public. So whether you're interested in investing in turnkey rentals with us or just learning how to identify another market to invest in, our website is renttoretirement.com. That's renttoretirement.com. You can also text REI to 33777 to get on our email dispo list. But the first thing we want to do is schedule a consultation with you with our investment strategist, learn about your goals, criteria, timeline, resources, help match you with the right properties and locations, financing options, and help you build an investment strategy to ultimately accomplish your goals. And so that's what you can expect when you reach out to our team.
All right, perfect. I will put the link in the show notes. So if you guys want to reach out, just click a little more in the description. It'll pull down that full description, and in there you can find Zach's link. All right, man, that wraps it up. Thank you very much for hopping on the show.
Thanks so much, Gabe. It's been a pleasure.
Absolutely. For everybody who's here with us today, thank you guys for showing up. You are the reason we do this. So if you guys have any questions at all, reach out to me, Gabe at therealestateinvestingclub.com. If you want to support the show, just give us a review on Apple or Spotify or whatever you're listening to this on. Other than that, I hope you guys have a great week. Keep rocking real estate, and I look forward to seeing you on the next episode. All right, before I officially sign off, I have a quick announcement to make. If you're interested in becoming a passive investor in one of my deals, my own company, Kaizen Properties, is looking for capital partners for our upcoming projects. We invest in what are known as recession-resistant assets, mainly self-storage facilities, mobile home and RV parks, and industrial properties. If you're interested in investing and would like to learn a little bit more about my company, our investing criteria, and some of the previous projects we've done, go to the Real Estate Investing Club podcast at therealestateinvestingclub.com and scroll all the way down to the bottom of the page. Click on the Invest With Us button. That'll pop up the investor form. Fill that out, and we will reach back out to you as soon as we can. Or if you prefer a little bit more of a personal touch, you can reach out to me at Gabe at therealestateinvestingclub.com. So really, that is it. Again, it was a pleasure hanging out with you guys during this episode, and I look forward to seeing you on the next episode.